My name is Kevin Kerr, and I'm in for Klaus Vogt this week on Money and Markets TV. For a very long time now, America has enjoyed a seemingly endless, cheap, and abundant variety of foods from all over the globe. And as a result, we take that food for granted. We don't think about the costs associated with producing, harvesting, packaging, and shipping the items we come to expect from the market every day. But now, I believe the age of cheap food is coming to an end. Let me explain. In emerging markets such as India and China, the middle class is exploding, and they're demanding things never before they've had. Cars, better housing, electronics, and above all, better food. Demand is surging for meats, better quality grains, and other soft commodities like coffee, cocoa, and sugar. This huge increase in demand is rapidly outstripping supplies of many resources and putting a strain on the already overloaded agriculture system. And meanwhile, the amount of arable land in the world is decreasing due to poor farming methods and population growth. According to the U.S. Census Bureau, the world population will soar to more than 9 billion people by the middle of this century. To put that number in perspective, consider that there were only 2.5 billion people worldwide in 1950. As the global population explodes, well, demand for food, fuel, land, all of it will increase at a frantic pace. And of course, as demand goes up, so will prices. We're seeing this already as surging food and fuel prices hits consumers hard, right in the wallet. According to the Department of Agriculture, 44 million people are now on food stamps. It's a record high, depressing record. And, well, things are even worse in poor and developing countries. Simply put, 2011 is shaping up to be a very expensive year for agriculture and potentially a very profitable year for those who are invested in it. You may be hearing the other side of the argument right now from some investors and fund managers. They say the market's simply speculator driven, that they say that there's no real inflation. They say the dollar will strengthen, the commodities bubble will burst, and prices will return to cheap levels that we've all been used to. But I disagree. This is not a bubble, and the chances of prices falling by any significant amount are slim to none. The biggest reasons for commodities booming right now are the physical demand and the weak U.S. dollar policy. It's ongoing. Those problems are certain to persist and even worsen. So, consumers and investors must look for ways to hedge themselves against the resulting cost increases. I believe one of the best ways to take advantage of rising agriculture markets right now is by using commodity ETFs. For example, consider the PowerShares DB Agriculture ETF, ticker symbol DBA. It's an unleveraged ETF with broad exposure to agriculture commodities, including soybeans, cattle, sugar, corn, coffee, cocoa, wheat, and cotton. If you want extra leverage on that, you can go for the PowerShares DB Agricultural, the double long ETN symbol, ticker symbol DAG. And for a more specialized trade, there's the iPath Dow Jones AIG Grains Total Return Sub-Index ETN, ticker symbol JJG. This exchange-traded note is solely focused on 3 primary grains: wheat, corn, and soybeans, my favorite. It uses futures contracts to establish its positions, the same approach as PowerShares ETFs. But before you jump into any trading strategy for the rising food and fuel markets, be sure to get advice from an expert who understands the resource markets inside and out, because they can be extremely fast-paced. I'm Kevin Kerr for Money and Markets TV. Thanks for watching.